What is happening in the markets right now? Welcome back to Bitcoin Bulletin, your absolute go-to for the news that moves you. We've got a whirlwind of updates that you need to know, so buckle up because the pace is insane. From groundbreaking Treasury strategies to massive shifts in institutional focus, the crypto world is buzzing like never before, and we're here to break it all down for you. Get ready for the insights that will keep you ahead of the curve. First up, we're diving deep into a revolutionary approach to Bitcoin integration that could redefine decentralized finance and the very value of Bitcoin itself. Then, we're asking the million-dollar question. Is Ethereum quietly becoming the new king, capturing the attention of major players and shaking up the established order? We'll also explore the undeniable impact of the ETF surge and what it means for the future of both Bitcoin and Ethereum, potentially signaling a new era of market growth. And finally, get ready for a bold corporate play that's putting Bitcoin squarely at the center of its treasury operations, a move that could set a precedent for businesses everywhere. Don't miss a single second of this action-packed episode. Hit that like button, subscribe, and ring that notification bell so you never miss an update. Revolutionary Bitcoin staking on Starknet unveiled. A seismic shift is occurring in the decentralized finance landscape, with the introduction of Bitcoin staking directly on the Starknet network. This development promises to unlock new avenues for yield generation on Bitcoin, potentially transforming its role from a simple store of value to a dynamic, interest-bearing asset within the DeFi ecosystem. The implications for both the future of decentralized finance and the intrinsic value of Bitcoin are profound, suggesting a significant reevaluation of how digital assets can be utilized and monetized. The core of this innovation lies in leveraging Starknet's Layer 2 scaling solution to enable Bitcoin holders to participate in staking activities without compromising the security or immutability of the Bitcoin network. Traditionally, Bitcoin's robust security model has made it challenging to integrate directly into DeFi protocols that require smart contract functionality and on-chain collateralization. However, by utilizing advanced cryptographic techniques and bridging solutions, this new approach allows Bitcoin to be wrapped and staked on Starknet, effectively making it compatible with the burgeoning DeFi world. This process involves converting native Bitcoin into a tokenized representation on Starknet, which can then be locked into staking contracts to earn rewards. The rewards themselves are typically generated from transaction fees or other network incentives, providing a direct economic benefit to Bitcoin holders who opt into this staking mechanism. The potential benefits are multifaceted. For DeFi users, it introduces a highly sought-after asset into a wider array of financial products, from lending and borrowing to derivatives and yield farming, thereby increasing liquidity and innovation. For Bitcoin itself, it offers a pathway to generate passive income, potentially attracting a new wave of investors who are seeking both capital appreciation and yield. This could fundamentally alter Bitcoin's market dynamics, moving it closer to traditional financial assets that offer returns. Furthermore, by utilizing Starknet, a network designed for scalability and low transaction fees, the staking process is expected to be more efficient and cost-effective compared to other potential Layer 1 solutions. This efficiency is crucial for making staking accessible to a broader range of participants, not just large institutional players. Analysts and early adopters are buzzing about the potential for this to create a game-changer scenario for Bitcoin. The ability to earn yield on a significant portion of the Bitcoin supply could lead to increased demand and a more robust market, potentially driving up the value of BTC. Discussions are already circulating on community forums and social media about the optimal staking durations, reward rates, and the security implications of interacting with smart contracts. The sentiment is overwhelmingly positive, with many viewing this as a crucial step in Bitcoin's evolution towards becoming a more integrated and versatile financial asset. But is this the only major development shaking up the crypto space? We're about to find out. Next, we're turning our attention to a potentially seismic shift in institutional investment as Ethereum emerges as a new focal point. Ethereum's ascent is the flippening imminent. The cryptocurrency market is witnessing a significant recalibration as institutional investors increasingly divert capital from Bitcoin towards Ethereum. This strategic pivot is not merely a trend, but a calculated move driven by Ethereum's superior yield-generating capabilities, a clearer regulatory path, and its ongoing technological advancements, positioning it as a formidable contender in the institutional investment arena. The primary catalyst for this shift is Ethereum's ability to provide attractive yields through staking. With current staking returns hovering around 3.8%, institutions find Ethereum a compelling option, offering passive income without the regulatory complexities associated with some other investment vehicles. This yield generation is particularly appealing in a market seeking stable returns. Compounding this appeal is the evolving regulatory landscape. The U.S. Securities and Exchange Commission's (SEC) recent classification of Ethereum as a utility token has bestowed a new layer of legitimacy, significantly easing institutional apprehension and paving the way for greater adoption. This regulatory clarity is a critical factor for large capital allocators who prioritize compliance and predictable frameworks. Whale addresses, often seen as bellwethers of market sentiment, are actively participating in this transition. Reports indicate substantial movements where large holders are divesting Bitcoin to acquire Ethereum. One notable instance involved 9 addresses offloading Bitcoin to purchase approximately $456 million worth of Ethereum. In another significant transaction, an entity sold 24,000 BTC, valued at around $2.59 billion, to reinvest in ETH. These large-scale movements underscore a growing institutional conviction in Ethereum's future potential. The burgeoning interest in Ethereum ETFs is a testament to this institutional embrace. These financial instruments provide a regulated and accessible gateway for traditional finance players to gain exposure to Ethereum. Inflows into Ethereum ETFs have reportedly surpassed those of Bitcoin ETFs since early August 2025, accumulating over $30.5 billion by mid-August 2025. The success of these ETFs is attributed to their ease of access, the regulatory clarity provided by Ethereum's utility token status, and the inherent yield-generating opportunities through staking, making them highly attractive to a risk-averse institutional base. This trend is also reshaping the fintech landscape globally. In Asia, startups are pivoting their focus to Ethereum, integrating its smart contract capabilities for innovative use cases like automated payroll, invoicing, and supply chain management. European SMEs are similarly leveraging Ethereum's clearer regulatory standing for crypto banking, enhancing payroll and treasury functions. Decentralized autonomous organizations, DAOs, are also adopting Ethereum-based payroll solutions, benefiting from its speed, smart contract efficiency, and integration with stablecoins, all supported by a developing regulatory framework. Audience impact. The market is keenly observing this institutional capital flight from Bitcoin to Ethereum, with many analysts suggesting this could lead to a significant reevaluation of market dominance and asset valuations. The narrative is shifting, and the impact on future investment strategies is undeniable. But as institutional focus shifts, another major financial development is creating waves across the market. Next, we examine the impact of a widespread ETF surge and its potential to ignite a structural bull market for both Bitcoin and Ethereum. ETF surge ignites structural bull market debate. The financial world is abuzz with the unprecedented surge in exchange-traded funds, ETFs, sparking a crucial debate. Is this wave of product innovation heralding a new structural bull market for both Bitcoin and Ethereum? The proliferation of ETFs across various asset classes has historically been a strong indicator of market maturity and institutional adoption. In the cryptocurrency space, the recent approval and subsequent success of Bitcoin ETFs have been nothing short of transformative. These products offer investors a regulated, accessible, and familiar way to gain exposure to digital assets without the complexities of direct custody or wallet management. The significant inflows into these ETFs suggest a substantial unmet demand from both retail and institutional investors eager to participate in the crypto economy. This trend is not limited to Bitcoin. The groundwork laid by the Bitcoin ETF success is paving the way for similar products centered around Ethereum. As the market anticipates the approval of Ethereum ETFs, many analysts believe that a similar influx of capital is imminent. Ethereum's unique value proposition, including its role in DeFi, NFTs, and its transition to a proof-of-stake consensus mechanism, makes it a compelling asset for a diversified investment portfolio. The potential for Ethereum ETFs to offer yield through staking further enhances their appeal to institutions seeking income-generating assets. The structural bull market argument hinges on the idea that the introduction of regulated, liquid investment vehicles like ETFs fundamentally alters the supply and demand dynamics for the underlying assets. By providing a more stable and accessible on-ramp for capital, ETFs can absorb significant buying pressure, potentially leading to sustained price appreciation. Furthermore, the increased visibility and legitimacy that ETFs bring can attract a broader investor base, including pension funds, endowments, and other large asset managers, who may have previously been hesitant to invest directly in cryptocurrencies. However, the debate also includes cautionary notes. Some analysts point out that the success of ETFs could also lead to increased market volatility if significant outflows occur, as seen in traditional markets. Others argue that the true test of a structural bull market will be sustained adoption beyond the initial hype cycle, driven by genuine utility and technological innovation rather than speculative inflows. The regulatory environment also remains a key factor, with ongoing developments potentially impacting the long-term viability and accessibility of these products. Audience impact. The market is keenly dissecting the correlation between ETF inflows and price action, with many investors looking to these products as a primary indicator of future market trends. The narrative around digital gold for Bitcoin and digital oil, or programmable money, for Ethereum is being reinforced by the accessibility ETFs provide. While ETFs are reshaping the investment landscape, a surprising corporate move is making headlines for a different reason. Next, we delve into Metaplanet's ambitious Bitcoin strategy and what it signifies for startups. Metaplanet's bold Bitcoin Treasury strategy signals new era for corporate holdings. In a move that has sent ripples through the corporate finance world, Japanese hotel group Metaplanet has announced a massive capital raise of $130.3 billion, with a significant portion earmarked for bolstering its Bitcoin treasury. This audacious strategy positions Metaplanet as a potential trailblazer, aiming to establish itself as a premier Bitcoin treasury entity in Japan and offering a compelling case study for small and medium-sized enterprises, SMEs, and fintech startups globally. Metaplanet's plan involves issuing new shares internationally to secure the substantial $130.3 billion. The lion's share of these funds, approximately $123.8 billion, roughly $837 million, is designated for direct Bitcoin purchases. The remaining capital will support the operational aspects of managing a Bitcoin treasury. This strategic allocation signals a profound confidence in Bitcoin's long-term value proposition as a corporate reserve asset, moving beyond its traditional perception as a volatile speculative instrument. The company's board has given its full approval to this capital-raising initiative, underscoring a deliberate and calculated approach to integrating Bitcoin into its core financial strategy. This decision is particularly noteworthy given the increasing institutional acceptance of Bitcoin as a hedge against inflation and a store of value. By allocating such a significant amount to Bitcoin, Metaplanet is not only diversifying its corporate treasury, but also signaling a potential paradigm shift in how businesses view and utilize digital assets. Japan's regulatory environment, managed by the Financial Services Agency, FSA, provides a relatively clear framework for cryptocurrency operations. This clarity allows companies like Metaplanet to pursue Bitcoin Treasury strategies with less regulatory uncertainty compared to some other jurisdictions. While pre-clearance for crypto activities is not typically required, stringent compliance measures, including regular audits and adherence to anti-money laundering (AML) protocols, remain paramount. Companies must remain vigilant about evolving regulations that could impact their digital asset holdings and treasury management practices. The market's reaction has been largely positive, with Metaplanet's strategic direction gaining recognition through its inclusion in the FTSE Japan Index. This inclusion is a strong indicator of growing institutional interest and confidence in the company's innovative approach. CEO Simon Jarovich's expressed confidence in the strategy further amplifies the message of Bitcoin's increasing acceptance as a legitimate long-term corporate asset. Implications for SMEs and fintech startups. Metaplanet's move offers valuable lessons for SMEs and fintech startups worldwide. Diversifying treasuries with Bitcoin can serve as a hedge against inflation and market volatility. Adopting a long-term perspective, focusing on sustainable growth rather than short-term gains, is crucial. Furthermore, understanding and complying with local regulations is non-negotiable for successful crypto treasury management. For Asian fintech startups, adopting Bitcoin treasury management while mitigating market volatility can be achieved through non-dilutive financing, dynamic conversion of Bitcoin to stablecoins or fiat, and phased accumulation based on market conditions. Metaplanet's strategy, by demonstrating institutional trust and promoting regulatory clarity, sets a high standard for companies venturing into crypto treasury management in an increasingly digital economy. Audience impact. This bold move by Metaplanet is being closely watched as a potential blueprint for other corporations looking to integrate Bitcoin into their treasury strategies, potentially unlocking new avenues for growth and financial resilience. And that brings us to the end of another packed episode of Bitcoin Bulletin. Don't go anywhere, we've got a quick recap and your call to action coming right up. And that's a wrap on another electrifying episode of Bitcoin Bulletin. We covered a lot of ground today. Bitcoin staking on Starknet is poised to revolutionize DeFi, Ethereum is capturing institutional attention, the ETF surge could be fueling a structural bull market, and Metaplanet is making a massive bet on Bitcoin for its corporate treasury. If you found this update valuable, make sure to smash that like button, subscribe to the channel for more cutting-edge crypto news, and ring the notification bell so you're always the first to know. Don't forget to follow us on all social media platforms for real-time updates and join the conversation. We'll see you in the next one.